Now, today's topic is something that is quite pertinent. Some of you reached out to us requesting for this presentation. And as you're all aware that the new tax law provisions were made for the financial year 2021-2022 to enable the economy to bounce back. So some of these tax amendments were made and already passed. And today we have the experts from PwC to take us through. We shall have a presentation by Harriet Nakadu, and then we shall also have a presentation from Patricia Kigundu. So Harriet is, sorry, I need to go back a bit. Harriet is the manager, indirect tax. And then Patricia Kigundu is the senior associate, tax reporting and strategy. Later on, we shall tell you what areas they will be presenting on. Then we also have Nicholas Kabonge, who is manager indirect tax. The fourth presenter is Hilda Kamugisha, who is manager tax, legal services. Hilda is the manager tax and legal services. I will request the team to later on also introduce themselves so that we get the correct titles. Then we shall have Daphne Namatovu, who is the senior associate tax and services. That is the team that is going to take us through the presentations this morning. And right now I would like to invite Harriet Nakadu to give a few remarks before we go into the presentation. Harriet, over to you.
Thank you very much, Anne. Good morning, ladies and gentlemen. Yeah, so my name is Harriet Nakadu, and I'm a senior manager leading the indirect taxes team at PwC. So together with my colleagues here today, we are happy to have the opportunity to discuss and present to you the amendments to the domestic tax laws, which took effect in July, on 1st July 2021. So we shall start with a quick or brief recap about the national budget that was read back in June 2021. Yeah, the theme for the budget for FY22, financial year 2022, was the road to recovery and building economic resilience. Yeah, I hope everyone can see our screen.
Yes, we can see it. Just to make it full screen. Ah, perfect. There we go.
So the agenda, Anne has gone through the agenda. We may not need to. And as we were saying, financial year 2022 was the road to recovery and building economic resilience. So you find that the underlying objectives of the budget framework were mainly aimed at addressing the effects of the pandemic. And some of the ways that this could be done was by increasing government's initiative to promote investment by boosting one of the ways to achieve the recovery that government anticipates was to increase government's initiative to promote investment by financing the private sector and boosting business activity. Another objective was to promote agro-industrialization. And in order to do this, government will eventually or ultimately increase productivity and the value addition in the agriculture sector. Another item was to encourage digital transformation, mainly aimed at enhancing efficiency and business continuity within the various industrial sectors. So when we have all these items in place, government expects that the economic growth, together with the increased business activity, the projected economic growth for FY 2022 is expected to be 3.3% compared to FY 21, where it closed at 3%. And in addition to that, government is targeting the tax revenue collection for FY 22 to close at 20.8 trillion, which is a modest increase when compared to the tax revenue that was collected during FY 21 of 19 trillion. Yeah, so in the interest of time, I'll go straight to introduce our presenters again, and I've already mentioned them, but following the agenda for our presentation today, my colleague Daphne Namatovu, a senior associate in the tax consulting team at PwC, will take us through the amendment to the Income Tax Act, after which I will be discussing the amendments to the VAT Act. Then next we'll have my colleague, another colleague, Nicholas Kabonge, a manager in the indirect taxes team at PwC, who will discuss the changes that were made to the Excise Duty Act. We also have Patricia Chigundu, a senior associate in the tax reporting and strategy team at PwC. Patricia will be discussing the changes that were made to the Tax Procedures Code Act. And last but not least, we shall have Hilda Kangisha, a manager in the legal services team at PwC. And Hilda will take us through the changes that were made to the Tax Appeals Tribunal Act, the Mining Act, and the Stamp Duty Act. Yeah, so with those few remarks, I'll go ahead to invite Daphne to discuss the changes that were made to the Income Tax Act. Daphne, you're welcome.
Thank you, Harriet. Good morning to you all. My name is Daphne Namatov, and I'll be taking you through the Income Tax Amendment Act. The first amendment we're looking at is on the definition of a beneficial owner. As we can see, this definition was amended to include legal persons and also trusts and any other legal person similar to a trust. But what we see is that this new definition still reaffirms a beneficial owner to be a natural person. So what then that means is that all payments that are made outside Uganda, in order for them to qualify for the tax treaty benefits, the beneficial owner has to be a natural person, among other conditions that have to be met. We have not yet seen how URA is going to implement this amendment, and we're looking forward to see how it will be implemented. The second amendment was on the definition of a consideration. We see the Income Tax Act now has brought in a definition of a consideration, which should be taken into consideration when computing capital gains and losses on disposal of assets. And this definition is similar to the definition that we see in the VAT Act. And we see that the consideration comprises of duties, levies, any other charges. However, any taxes that are to be paid, for example, withholding tax or VAT, these should not form part of the consideration. Moving on to the next amendment, that's on the definition of an exempt organization. So previously, for an organization to meet the criteria of an exempt organization that was provided for in the Act, that was the public character criteria. This has now been amended, and the new criteria to be met is the non-profit criteria. So what this means is that these organizations, in order to qualify as exempt, they have to meet the non-profit criteria, which we see that is very easy to meet, as most of them are already meeting this criteria. However, although they meet this criteria, they still need to make an application to the URA. Most of these taxpayers have found it difficult to seek approvals from the URA to apply the income tax exemptions once they've made the applications. And this is mainly because once this application is made, it prompts an audit from the URA. So the objective here is to ensure that once the organizations know that they meet the non-profit criteria, they should then ensure that they make this application on time and also build a relationship with the URA so that in case URA needs any information that they would like to clarify from the organization, it's provided and the income tax exemption is provided to them on time. It's also important to note that these exemptions are renewable annually, and at the end of the year, the organization is required to submit a new application. Moving on is on the amendment of the taxation of rental income. So before we saw individuals, a standard deduction equal to 20% of their gross rental income was allowed for income tax purposes, and also their chargeable income was subject to 20% income tax. However, when you look at the non-individuals previously, that's before 1st of July 2021, the non-residents would be able to claim a tax deduction on their actual rental expenses, and also the income tax rate applicable on their chargeable income was 30%. For the individuals, the effective tax rate prior to 1st of July 2021 was 16%, while for the individuals, for the non-individuals, it was 30%. However, effective 1st of July, we are now seeing that both the individuals and then the non-individuals, they are allowed a standard deduction equal to 75% of their gross rental income, and also the income tax rate for the chargeable income for the individuals has increased from 20% to 30%. In a brief illustration that I have here for you is showing the before and after. So before, like I had mentioned, if an individual had rental income equivalent to 10 million in a year, they'll be allowed a standard deduction, 20% of that gross rental income, and their chargeable income would be taxed to 20%. In addition to that, there was a threshold of 2.8 million that would be applicable. For the non-individual, however, who has rental income for the year equivalent to 10 million, that rental income will be subject to 30%, and they also were able to have a deduction of their actual rental expenses. But effective 1st July, both of the individuals and non-individuals, their rental income would be allowed a deduction of a standard deduction equal to 75% of their gross rental income, and their chargeable income would be subject to tax at 30%. So what we're seeing here is that both the individuals and non-individuals now have an effective tax rate of 7.5%. One would ask, is this good for the individuals or is this good for the non-individuals? For individuals, if we compare the two illustrations, we see that with the 30% tax rate and also the increase in the allowable deductions to 75%, it reduces the tax they would have to pay during the year. However, would this be the same case for the non-individuals, especially those whereby their actual rental expenses are more than the 75%? Also, it's important to know that that threshold that was applicable to the individuals is now no longer applicable. We're still waiting to see URA amend the rental income tax returns, as they still show the old tax rates and also the threshold for purposes of the individuals. Moving forward is on the amendment on the asset classification. So the Act reduces the classes of the depreciable assets from 4 to 3, and this is by merging class 2 and class 3, which provided automobiles in one class. What this means is that automobiles will be subject to a tax depreciation rate of 20% as opposed to 30 or 35. Therefore, if they're taxpayers whereby they're dealing in the transportation business or 90% of their assets are automobiles, their chargeable income will increase based on this reduction of the classes of the depreciable assets. URA has not yet amended the return as of today to reflect the 3 classes. It's still showing the 4 classes, but we're waiting for those amendments to be made in the return. But also there'll be need for URA to provide more clarity on how the tax written down value of the assets previously mapped in class 2, which had both plant and machinery and automobiles, how these should be moved, whether they should, that those tax written down values should remain in class 2, or they should be moved to class 3, and how and what value should be moved by the taxpayer. The next is on the deferral of capital allowance. So the Act defers the deduction for depreciable assets that qualify for initial allowance to the next year. What this means is that the double deduction, that's the standard depreciation and initial allowance, is now no longer available. So for example, if we look at some of the assets acquired by a taxpayer that are outside the 50-kilometer radius from Kampala, effective 1st of July, they're likely to have a higher effective tax rate since only 50% of investment can be claimed in the first year. The Act has also introduced Section 50, and this is mainly on indexation of an asset cost when calculating a capital gain. This section is requiring a taxpayer to apply the consumer price index to the cost base when calculating the gain on disposal. And once the consumer price index is applied, it will ideally reduce the gain on the sale of the assets by the inflation amount. The introduction of this section is mainly to eliminate taxation of the inflationary complement of capital gains, but also mainly to encourage investors to sell their assets, which would increase the investment growth in Uganda. Another section that was introduced is Section 54, and this is mainly on the recognition of gains or losses by registered venture capital funds. As we all know, the venture capital funds were set up mainly to assist small businesses, startup businesses in Uganda, and encourage them to invest, and eventually the investment growth in Uganda would increase. With the introduction of this section, what it means is that the gains and losses on the disposals of an investment interest by a registered venture capital fund will not be recognized for income tax, where at least 50% of the sale proceeds are reinvested within the same year of income. And with this provision, like I've mentioned, it's going to promote growth in investment in Uganda. Moving on to another section that was introduced specifically for the automatic exchange of information. Now, ideally, where there is an international agreement between the two parties, a non-resident and Uganda, and it provides for sharing of information, the Commissioner General of the URA will facilitate the automatic exchange of such information. This provision clarifies how URA will meet its obligations under the OECD Multilateral Convention on Mutual Administrative Assistance in tax matters, and to enable URA collect more revenue. And this is mainly because they will have obtained more information on the taxpayer with regards to this section. Yes, the Act has also amended the section in respect to the refunds. And this amendment is mainly to cater for situations where there is delay in refunds due to delay in the taxpayer submitting the requested documents. Now, the process of a tax refund requires the taxpayer to apply to the URA, submit the application to the Commissioner for verification. And then once this is done, then the taxpayer will sit back, wait for the Commissioner to issue their response and refund the funds. However, interest would start to accrue once the application has been submitted. Now, this amendment is to cater for those delays and also manage the accrual of interest. What this means is that if the commissioner and the URA team do issue findings and are requesting the taxpayer to provide more clarification prior to approving the refund, then the acknowledgement date for when the commissioner has received the refund will move from the date of application to the date when the taxpayer has submitted the additional information. Now, this is, like I had mentioned, the interest on late payment for remitting the tax refund will then start to accrue at the point that the additional information has been submitted, as opposed to when the initial application was made by the taxpayer. Lastly, on the agro-processing exemptions, we see that black it shows that these exemptions for agro-processing have been narrowed to specific sections within the sector and will only be applicable if certain conditions are met. Before I invite Harriet to take us through the VAT exemptions, the VAT amendments, I'll speak about the proposals that were withdrawn. The first proposal that was withdrawn was one on the taxation of rental income. And on the good side, we see that a favorable percentage was provided, which I had discussed, which is 75%, as opposed to the 60% limit on the deductions. Then the second was on the 6% withholding tax exemption on the purchase of a business or business asset. What this means is that, yes, if a taxpayer is exempt from the 6% withholding, on transactions whereby they are purchasing a business or business asset, that exemption will not apply. And what that means, they would have to oblige and account for the withholding tax accordingly. Thank you all. I'll now invite Harriet.
Thank you very much, Daphne. So as mentioned earlier, it's Harriet Nakadu. I'm back to discuss the changes or the amendments to the VAT Act. Yeah, so we'll start quickly with the highlights of the amendments. The Amendment Act 2021 introduced a timeline of 6 months within which to claim a credit for input tax incurred. It also encouraged the use of e-invoicing and e-receipting by introducing a refund of input tax incurred on purchases by non-taxable persons for as long as these purchases were e-invoiced or e-receipted. Then the amendments imposed penal tax for errors and omissions that are made when you're submitting any information to the tax authority, irrespective of whether the errors and omissions were done knowingly or unknowingly or not recklessly. Then the Act went ahead to introduce a number of items on the list of exempt supplies, while excluding other items from the exempt list as a way of providing incentives to investors. So diving into the discussion of the amendments, we shall start with the amendment that changed the numbering of Section 20. In that previously, the VAT Act had Section 20, which described an exempt import. Now this section was changed to become Section 20, subsection 1, and it's still defining or describing an exempt import as it was in the former Section 20. Then the Amendment Act went ahead to repeal Section 20A and introduced another Section 20, subsection 2. So you find that Section 20, subsection 2 incorporates the previous provisions that were in Section 20, and now it reads that it provides that an import of a service is an exempt import if the service would be exempt had it been supplied in Uganda or would be used in the provision of an exempt supply. So you find that the former Section 20A was providing that an import of a service is an exempt import if the service would be exempt had it been supplied in Uganda. Now, Section 20, subsection 2 goes ahead to add another statement, or would be used in the provision of an exempt supply. So this new statement is going to benefit several suppliers of exempt supplies, especially people in the financial services sector and others that are providing life assurance services. So we shall move on to the next amendment, where they limited the period within which to claim input VAT. So with effect from 1st July 2021, a person can only claim the input VAT credit up to a period of 6 months from the date of the invoice. So in the previous legislation, a person was able to claim the input VAT at any time for as long as they had a proper tax invoice. However, going forward, once the date of the invoice exceeds a period of 6 months, then you may be denied the opportunity to take advantage of that input tax credit. And maybe you can reach out to URA on a case-by-case basis to see whether your reasons can be considered. We also noted that the effective date of this amendment is actually affecting invoices that are dated prior to 1st July 2021. Examples of these right now are invoices dated December 2020 or November 2020. In the near returns, they will be more than 6 months old. So we are yet to see how that is going to play out and whether the taxpayer can be allowed on a case-by-case basis to get a credit of this input tax incurred. Then we also noted that this amendment contradicts the financial year 2020 amendment, which allowed manufacturers that are getting newly registered for VAT to claim the input tax they incurred within 12 months prior to their VAT registration. So this amendment was allowing this for as long as this manufacturer has the goods in stock at the time of registration. So we need URA to clarify on how this is going to play out alongside the restriction of the 6 months period within which to claim the input tax incurred going forward. So we shall move on to the next amendment, where with effect from 1st July 2021, a non-resident person or a part taxable person who supplies services to non-taxable persons is expected to file returns 15 days after the end of 3 consecutive months. So again, we're expecting guidelines from URA on how this amendment will be implemented. But in the meantime, our interpretation on how this amendment will be applied is to the effect that the change does not affect the resident taxable persons, because such people are already filing their VAT returns on a monthly basis. Then that means or implies that other than a resident taxable person, the amendment will affect non-resident people or non-resident suppliers who are providing services to non-taxable persons. So again, the VAT Act defines a non-taxable person as a person or persons who are not required to register for VAT. So putting this together, that means that a non-resident person who is providing the following services that were listed in the Amendment Act, for example, services in connection with immovable property in Uganda, or radio or television broadcasting services received at an address in Uganda, or electronic services delivered to a person in Uganda, or telecommunication services initiated by a person in Uganda. So for as long as the non-resident person is providing any of the services listed above to a non-taxable person in Uganda, or to a person who is not registered for VAT, then that non-resident person will be expected to account for VAT after 3 consecutive months, or within 15 days after the end of 3 consecutive months. So in order for this to apply, we are of the view that the non-resident person should meet the VAT annual registration threshold of making supplies amounting to at least UGX 150 million for supplies made in Uganda, because that's when this non-resident person can be regarded as a taxable person in Uganda. Then it also follows that this non-resident person will be required to register for VAT. And maybe another clarification that we expect is for the URA to clarify whether the tax period for a non-resident person is going to be a period of 3 consecutive months when compared to the current tax period for a resident person, which is a month. Yes, so we shall be getting those updates from URA in due course, and that will help us to determine the due date for paying tax by this non-resident person. Then we also noted that the amendment, or we observed that the amendment provided an opportunity for a non-taxable person to obtain a refund of input tax for as long as the input tax is supported by electronic receipts or invoices. So what does that mean? This amendment applies to persons who are not required to register for VAT. Those are the non-taxable persons. Then such people are getting the opportunity to claim or to obtain a VAT refund in respect of 5% of the input tax they've incurred on purchases of goods or services worth 5 million. So the condition is that the non-taxable person should have procured purchases of goods or services worth at least 5 million in a period of 30 consecutive days. And these purchases should have been e-invoiced or e-receipted in order for that person to qualify for a refund of 5% of the input tax they incurred. So you find that this amendment was aimed at encouraging the use of the electronic fiscal reporting and invoicing system, which ultimately will enhance the VAT administration and accountability going forward. So again, just like most of the other amendments, we are waiting for guidelines from URA on how this is going to be implemented. But what we know for now is that the non-taxable person will not be required to apply for the VAT refund. Instead, when they're making these procurements or these purchases, they will share their TIN or tax identification number with the supplier. And in the event that they don't have a tax identification number, they can share the national identification number, the NIN, with the supplier. Then at the back end, URA will be able to compile this information and process the refund within 90 days after the expiry of the 30 days period within which the purchases were made. So we are told, or we are informed that the persons don't have to file the VAT returns. The process will be handled at the back end by the URA. The next amendment repealed the words knowingly and recklessly from section 65(6) of the VAT Act. So this means that a person who makes a statement or declaration to an official of the Uganda Revenue Authority that is false or misleading in a material particular, or this person omits from a statement made to an official of the Uganda Revenue Authority any matter or thing without which the statement is misleading in a material particular, and the tax properly payable exceeds the tax that was assessed, or the refund claimed was false, or submitted a return with an incorrect offset, then this person going forward will be liable to a penal tax, whether or not these errors or omissions were done unknowingly or not as a form of recklessness. So previously, the The penal tax would not have applied if such a statement or declaration was considered to have been made unknowingly or not recklessly. But going forward, you will be liable to a penal tax whether you are aware or not aware of the errors or omissions that were in your return that you filed with the URA. Then the amendments also added the African Export-Import Bank and the International Union for Conservation of Nature on the list of public international organizations. So these two organizations are also going to be entitled to certain privileges under the VAT Act going forward. And then the next amendments, we also noted that a number of items were introduced or included onto the list of exempt supplies, and these include the supply of liquefied gas, the supply of denatured fuel from cassava, and also there was another amendment which is quite long. I can read it verbatim for now before we break it down to describe what it means or to explain what it means. So it's the supply of services to a manufacturer other than a manufacturer operating within an industrial park, free zone, or who invests at least USD $30 million if it's a foreign investor, or USD $5 million if it's a local investor, to conduct a feasibility study or to undertake design and construction. Or in the case of any other manufacturer, from the date on which the manufacturer makes an additional investment equivalent to US dollars 30 million for a foreign investor or 5 million for a local investor who has the capacity to use at least 70% of the raw materials that are locally sourced, subject to their availability in Uganda, and who has the capacity to employ at least 70% of the employees who are citizens of Uganda and at the same time earning an aggregate wage of at least 70% of the total wage. So what does this long amendment mean? We've broken it down in the subsequent slides in that the supply that is being exempted now is the supply of services to conduct a feasibility study or to undertake design and construction services. Now that's the new exempt supply. However, these services, in order for them to be exempt, they should be supplied to a manufacturer other than a manufacturer operating within an industrial park or free zone. So what that means is that the services should be supplied to a manufacturer who is operating outside an industrial park or free zone. So the other requirements for this exemption to apply, the manufacturer should have invested at least USD $30 million if it's a foreign investor, or USD $5 million if it's a local investor. Then the person who is supplying services to conduct a feasibility study or to undertake design and construction services to such a manufacturer will be treating those supplies as exempt supplies. There is also another category that is benefiting from this exemption, and this is any other manufacturer who from the date of the manufacturer, who from a particular date makes an additional investment equivalent to $30 million US if it's a foreign investor, or USD $5 million if it's a local investor. So what this means is that it could be a manufacturer making a new investment or another manufacturer who is making an additional investment of $30 million and $5 million respectively. So in this instance, both manufacturers in categories 1 and 2 are expected to have the capacity to use at least 70% of the raw materials, being locally sourced, subject to their availability in Uganda. And they should also have the capacity to employ at least 70% of their employees being citizens of Uganda. In addition to that, the employees who are citizens in Uganda should be earning an aggregate wage of at least 70% of the total wage of that company or that entity. Yeah, so the proposed measure is actually welcome because it's strategic in a way of increasing investment in Uganda, while at the same time creating employment and encouraging the use of local content. However, given the fact that it's making the services exempt, that means the cost of these services has to be factored into the price of the service of the supplies that are being manufactured going forward, which may end up making them more expensive. So we have the view that it would have been a better deal if the services were zero rated as opposed to exempted from VAT. Yeah, so the Amendment Act also removed a number of items from the VAT exemption regime. For example, the supply of services to a hotel or tourism facility, and some of the services which were listed were conducting a feasibility study, design and construction, then the supply of locally produced raw materials for construction of premises, machinery and equipment, or furnishings and fittings which are not manufactured on the local market. So going forward, these supplies are no longer exempted from VAT. And we also noted that this incentive was initially introduced in 2018 for developers who had invested USD 10 million in hotel facilities that had a room capacity exceeding 100 guests. So going forward, such services are no longer exempt from VAT. They are generally standard rated. Then the supply of production inputs into limestone mining and processing into clinker in Uganda, and the supply of clinker for further value addition in Uganda were also excluded from the list of exempt supplies going forward with effect from 1st July 2021. So these two items were initially introduced on the exempt list in 2018, and turning them to taxable supplies will have an impact on the items that are produced, because going forward, these supplies will be standard rated at a VAT rate of 18%, which input tax can be claimed by the manufacturer or suppliers as opposed to being factored into the price of their products or the prices of their products. And then we'll move on to the last amendment, where the supply of aircraft repair services became zero rated. So previously, the supply of leased aircraft, aircraft engines, spare parts for aircraft and aircraft maintenance were zero rated, but not the aircraft repair services. So going forward, they've added the supply of aircraft repair services among the zero rated services, which measure we believe is a welcome measure intended to support the aviation industry by reducing the additional cost of VAT on repair and maintenance services for aircrafts. So with that, we come to the end of our discussion for the amendments to the VAT Act, and I'll invite my colleague Nicholas to take us through the discussion of the changes that were made to the Excise Duty Act. Thank you.
Thank you, Harriet, for the presentation. Good morning, everyone. And thank you for making time to attend this session. As introduced, my name is Nicholas, and I'm a manager in the tax line of service. I'll be taking us through the tax amendments for excise duty that took effect on 1st July 2021. During my presentation, we shall cover the excise duty amendments that that were made. And as you're aware, there have been a number of changes to the excise duty rates applicable to the excisable goods and services in Uganda for the current period. The Amendment Act has also introduced some new excisable services and repealed certain services, notably the OTT or over-the-top services, which was replaced with the duty on internet data. It is worth noting that subject to Section 4 of the Excise Duty Act 2014, the excisable goods and services specified under this Schedule 2 are chargeable to excise duty specified in that schedule. The rates applicable normally take the nature of either ad valorem or specific in nature. Ad valorem rates are a percentage of the value, whereas the specific rates are fixed per the volume of the product. We shall now dive into the specific items that were amended and just look at the changes. So item 1 is the opaque beer. So previously, the rate applicable to opaque beer was 30% or shillings 650 per liter, whichever is high of the two. And now this has been reduced to 20%, to the high of 20% or shillings 230. Of course, this is a welcome change because it will boost production and this amendment is in line with the value-added services or the rates applicable for value-added services. The other item is any other alcoholic beverage which is locally produced, and this is a new category that has been introduced. The rate applicable here is the higher of either 20% or shillings 230 per liter. The other new category that was introduced is any other fermented beverages made from imported cider or near beer. And the rate applicable here is the high of either 60% of the value or shillings 950 per liter. The other new category that was introduced is any other fermented beverages made from locally grown cider or near beer. And the rate applicable here is the higher of either 30% or shillings 550 per liter. The other new category under these beverages is any other non-alcoholic beverage locally produced, specifically made from fermented sugary tea solution with a combination of yeast and bacteria. The rate applicable here is 12% or shillings 250, whichever is higher. The other item that experienced a change was the fuel. As you may recall, there was a proposal to introduce the annual license fee. However, when the parliamentary committee discussed that proposal, and of course with feedback from the public, they then proposed to drop it, and it was rejected. Then the change that was made was to just increase the excise duty on motor spirit and gas oil by 100 shillings. So effectively, the current excise duty on motor spirit is shillings 1,450 per liter, and that on gas oil is 1,130 per liter. The other change was to repeal the existing excise duty on plastics, which was specifically on sacks and bags of polymers of ethylene and other plastics under HS codes 3923-21 and HS code 3923-29, except for vacuum packaging bags for food, juices, tea, and coffee. So with this, then they introduced a new category, which is plastic products and plastic granules. The rate applicable here is the higher of either 2.5% or the ex-works price, of the ex-works price, or USD 70 per ton. The other change, which has had numerous discussions, at least in the media and the public, is on the telecom services sector. So as you may be aware, there was the over-the-top services tax, which was also referred to as OTT, and individuals used to pay shillings 200 per user per day of access. This has since been repealed, and it was replaced with the excise duty on internet data at a rate of 12%. That's on all internet data except data for provision of medical services and education services. The URA is yet to share guidance on how taxpayers can distinguish between data for general services and data for medical and educational services. The other change, as earlier discussed, was on the value-added services. The previous rate was 20%, so this was reduced to 12% of the fee charged in order to align with the single rate for the telcos. The other, as mentioned previously by Harriet and Daphne, there were changes that were meant to boost investment and manufacturing and industrialization. So one of the changes was strategic investment projects, where the proposal was that construction materials of manufacturers whose investment capital is at least USD 50 million, or any other manufacturer who makes an additional investment of USD 50 million should benefit from nil duties, on their products. Then the other change in line with this initiative of promoting investment and manufacturing was also the remission of duty on plastic packaging. This is supported by reconciliations and inspections, which are conducted by the URA. Specifically, here, the commissioner may remit or refund excise duty on plastic packaging used in packaging of exported goods, used in packaging of medicaments, and also used for the manufactured products that are manufactured from recycled plastics, where the recycled plastic is either 20% or more of the raw material used. As mentioned, this is in line with the government's initiative, not only to boost investment, but also to boost environmental protection. It is also worth noting that a person who fails to pay excisable duty by the due date, which is normally 15th of the following month, is liable to pay interest on the unpaid duty at a rate of 2% per month, compounded for the excise duty which is outstanding. As discussed earlier, I mentioned that one of the proposals that was rejected was the one of the annual license, where then they hiked the price per liter by 100 shillings, which is incorporated in the excise duty rate. The other proposal was to impose a new duty of shillings 100 per kilogram of wheat grain, which was also rejected. This is it from me. I will now hand over to my colleague Patricia to take us through the Tax Procedures Amendment Act. Thank you.
Thank you, Nicholas. Good morning, our dear listeners. Thank you very much for making time to attend this webinar. We're equally excited that you're here. My name is Patricia Chigundu. I'm a senior associate in the tax line of service, and I'll quickly be running you through the Tax Procedures Amendment Act on what has changed effective 1st July 2021.
So what we have here is just a quick summary and just a quick highlight of what we found as fascinating and what has since changed. And in summary, what this is intended to do is to simply first explain what was intended in making these amendments, and then we'll dive into the details of what these relate to. So the first one relates to the definition of a tax decision. And again, we'll dive into this in much detail later, but this definition has been amended, and the intention here is to make it more clearer, but the amendment relates to excluding certain paragraphs in that same definition where it will not comprise of a tax decision. In a nutshell, saying that if you have a decision being made by a commissioner, this will not comprise of a tax decision. So not to worry about it, we'll dive into this much further later. Then also the second amendment was in respect of a TIN required for issuance of a license. This again has been echoed in the Income Tax Act, and the intention here is to widen the tax base. And pretty much what they're saying here is that no government authority or institution is allowed to conduct any business with anyone who doesn't have a TIN. That is pretty much stringent, but we know this has been re-echoed so many times. The third amendment relates to the amendment of the self-assessment returns. And this pretty much, I think the intention was to make it more clearer, and the amendment relates to changing the period within which a taxpayer can amend a return upon discovery of an error. Again, we'll talk about this in much detail later. The fourth amendment is in respect of introduction of alternative dispute resolution procedures. This we found as fascinating and a welcome move by the URA, where in instance they're trying to say, as opposed to a taxpayer spending so much money running to the appeals court, they're actually saying that there are procedures available for such a taxpayer to address their grievances, and we'll dive into this much further later in the discussion. The fifth amendment relates to change in the order of payment of tax order. And again, this we found as pleasing, where they're basically saying, okay, initially there was a prescribed order. We'll discuss this further, prescribed order that had to be followed when a payment has been made, but that order has since changed. And again, you'll also find this exciting. Secondly, or the second last, is in respect of new offenses for tax stamps. You will notice here that they have stemmed up the offense of the penalties in respect of such offenses, and then other offenses that we'll dive into much later. So let me take an opportunity to go into the details that I've been saying we'll discuss in respect of each of those items. One is in respect of a definition of a tax decision. Initially, a tax decision, and this has been maintained, it is defined in the Act as a tax assessment. And just in a nutshell, what does a tax assessment mean? This means a self-assessment, ordinarily how you would file your normal income tax return or pay as you earn tax return. That's a self-assessment. It's also defined as a decision that is left to the matter of the discretion, judgment, opinion of the commissioner. But under that part, as you realize under part BI or 1, this decision excludes a decision made in relation to a tax assessment. What does this mean? It means that a tax decision does not comprise of a decision made in relation to a tax assessment. And the amendments that have been enacted include again, including or adding more decisions that will not comprise of a tax decision. And this is what you see under that paragraph called after a decision that, kindly give me a minute. A decision to refuse or revoke a practice note, a decision or omission that affects a tax officer, and that is in respect of an employee of the URA, a compoundment of an offense under any tax law, or a decision to refuse or issue a private ruling. In a nutshell, they're saying that a tax decision doesn't comprise of such decisions. So question is, where does it leave a taxpayer? It implies that in case a taxpayer is not happy with any of the decisions, for instance, a decision to issue or revoke a practice note, they would not have an avenue to formally object to such a decision, And it remains to be seen whether the new alternative dispute resolution procedures would be able to provide such a platform to challenge such decisions. The second item is in respect of a TIN required for business registration. As I had re-echoed earlier, no government authority is allowed to issue a license to a person who doesn't have a TIN. This is, as again we had already mentioned, it's already in the Income Tax Act. There have been drives already by the URA to encourage taxpayers to register for taxes. As you'll also notice in the URA report for 2020-2021, they've already indicated that by such moves or measures or media encouragement to taxpayers, they have registered 189,000 taxpayers already, which is quite encouraging. So again, this is to enhance taxpayer compliance, but also to widen the tax base. The second one is in respect of amending self-assessment returns. Initially, I'll give an example. If a taxpayer discovers an error in a self-assessment return they have made, for instance, you notice that in a month I filed a pay-as-you-earn return, and after a year, and after 2 years, I want to make a change to such a pay-as-you-earn return. At that time, there was a restriction, and the restriction was that such a taxpayer could not amend that return if it's in excess of 12 months. But now the amendment is saying that this period has been increased to 3 years. And we believe this is a positive amendment, and it will give an opportunity to taxpayers to correct and make those returns more accurate. The third one is in respect of the order of payment. Again, we had mentioned this is welcoming. And what was it initially? I'll just give an example. That if you have a taxpayer and you notice that, and you have made a payment in a month in respect of pay-as-you-earn, for instance, forgive me for using pay-as-you-earn a lot as a tax head, and you notice that you have to make a payment in a month, then if you make that payment, there was a prescribed order that payment had to settle. So what was the law initially? The law was basically saying that if such a taxpayer makes a payment in respect of pay-as-you-earn, the payment that they have made in that month would basically had to first settle any principal tax, penalty tax, and interest. But this prescribed law per the amendment now has been scrapped, meaning that a taxpayer has an opportunity to allocate that payment to the period they choose. As you may have noticed, that ledger reconciliations is a hefty exercise. It's a tiring exercise, and we believe that such an amendment would make such ledger reconciliations much easier. The last one is in respect of alternative dispute resolution procedures. And basically, as we had said, that this is thrilling to us. And what they're trying to say here, that if a taxpayer is not happy with a tax decision made by the commissioner, they have an opportunity to ask the commissioner to review that decision via such procedures. But again, we are yet to see guidelines being issued by Ministry of Finance in respect of how these procedures will work. But why are we saying that this is a good move? It's a good move because you may notice that running to court or going before TAT is not only a tiring exercise, but it's also expensive. So the intention here was to sort of reduce the pile of cases that are currently before TAT. And initially, I think you may have noticed that if you're not happy with the tax decision, then the only option available in the law would be to lodge an appeal before TAT within 30 days. But let's wait and see how this move will make this process more attractive. Then lastly, as we had mentioned, that as part of a compliance move and strengthening this revenue mobilization exercise by the URA, they've increased the penalties in respect of a number of offenses, and this includes tax stamps For instance, you have if you have a person who is actually using a tax stamp without goods, or actually using them wrongly, then we've seen penalties. I'll just summarize. Penalties have been increased to 10 million or 5 years, or both. What we are seeing here is, for instance, the failure to furnish a tax return by the due date. The prior law had 25 currency points. I must mention a currency point represents 20,000. So if a taxpayer fails to furnish a tax return by the due date, it was 25 currency points in the prior law. In the current law, that is 50 currency points. If you calculate that in UGX, that's about 1 million. Then the failure to comply with obligations in the TPC, initially the prior law had 25 currency points, that's about 500,000. The current law is actually telling you 100 currency points, that's about 2 million. So in a nutshell, this is what we're trying to emphasize, that URA has come out to indicate that failure to comply with your tax obligations, such a taxpayer would have to face hefty penalties as a result. So I'll leave it here for now, and I welcome my colleague Hilda to take us through the Tax Appeals Tribunal Amendment Act, the Stamp Amendment Act, and the Mining Amendment. Thank you very much.
Good afternoon, it's already midday. We're privileged to the Tribunal Act. That's the Act and the Mining Act. There's some interruption. So in government effort, the amendment to the act relating to investment and also the process of dispute resolution, transactions. Now, let me sort it out. Sorry, I forgot to introduce myself, but my colleague has mentioned that Hilda Kampucha, manager at the full stack line of service in So the amendment to the Tax Appeals Tribunal Act of 2021 is introducing the right of appeal at the High Court level. So initially, the Tax Appeals Tribunal provides for appeals up to the High Court. So a taxpayer who is satisfied with the decision of the Tax Appeals Tribunal would not go to the Court of Appeal to appeal the decision. And that was upheld in the recent case of Housing Finance Bank against the Uganda Revenue Authority. So right now, the amendment allows the taxpayer to appeal to the Court of Appeal where they're not satisfied with the decision of the High Court. That's great. Apologies, there seems to be a network problem. Let's sort it out and then I'll continue.
While we wait for Hilda to come back, I would like to thank you for attending our webinar and also to remind you to please fill out the feedback form. If you have any suggestions or a topic that you would like us to discuss, please let us know, and then we shall arrange that. Otherwise, we thank you so much for being an active audience. Keep the questions coming. After Hilda's presentation, we are going to go into our Q&A. So please send your questions. Hilda, are we ready?
I hope that network is clear now. So I hope you can hear me, just to confirm.
Yes, much better.
Okay, thank you. So the amendment to the Tax Appeals Tribunal Act seeks to give the taxpayer the liberty to appeal against the decision of the High Court, and that appeal will be filed within 30 days from the decision of the High Court, and the decision of the Court of Appeal must be delivered within 60 days from the date of filing that appeal. Again, we see the government is trying to provide for justice to the highest level to enable taxpayers to be confident in the tax that they're paying, and also for dispute resolution to be delivered and justly for that matter. Then after the Court of Appeal, there's also a room for appeals to the Supreme Court where the taxpayer remains dissatisfied. Such an appeal will be lodged with the permission of the Supreme Court and also issuance of a certificate by the Court of Appeal confirming that indeed there are matters of great importance that need to be determined. So again, the taxpayer may not appeal against each and every decision, but it has to be proved that there are matters of great public importance and that there are matters of law. So not every decision can be appealed, that must be satisfied. Again, we see the intention to expedite decisions because the Supreme Court is mandated to give their decision within 30 days from the date of filing the appeal. So this will unlock a lot of funds that are rendered redundant because of delayed judicial processes where courts take years to decide. So we're looking at an additional 90 days within which the Supreme Court will decide, and then URA and the taxpayer will be at liberty to apply whatever funds are held up by that dispute, which is a progressive decision for the economy. So we now move on to the amendments to the Stamp Duty Act, also very progressive and seeking to encourage investors in Uganda and also to encourage industrialization. So the amendment in 2021 provides for an incentive for new manufacturers whose investment capital is at least $50 million, and also new existing manufacturers who invest an additional 50 million United States dollars. This will be exempt from stamp duty on particular instruments, which before 2021 July were subject to stamp duty. It's notable that there were some incentives that were introduced in 2018 for operators within industrial parks and free zones. Now these are excluded from this amendment, the incentive in this current amendment, because they were catered for in 2018. So the new and existing manufacturers will only benefit from this exemption if they prove that at least 70% of the raw materials they use in their manufacturing processes are sourced in Uganda. They'll also have to prove that they will employ at least 70% of Ugandan citizens as their employees, and that the total wage bill that they pay constitutes at least 70% wages paid to Ugandan citizens. We see here government trying to promote the local content regime, which has been rolled out in the oil and gas sector and several other sectors, as well as the public procurement system, where Ugandans are enabled to access opportunities in employment and also in production, and also to ensure that Uganda is developed and value is added. So this incentive will definitely promote industrialization, but also provide opportunities for Ugandans. So it's a good one. Then we saw also an amendment in this current amendment to the Stamp Duty Act, which lightens the conditions that were set in 2018 for strategic investment projects. And this reduced the requirement for raw materials sourced in Uganda from 70% to now 50% raw materials sourced in Uganda. Then also, instead of the 2018 requirement to directly employ at least 100 Ugandan citizens, the 2021 amendment now requires the investors to prove a capacity to employ at least 100 Ugandans. So now we see an adjustment in the conditions, which probably signifies that the current conditions have not been favorable to investors, and so there's been an adjustment in that condition. So the instruments that are exempted from stamp duty to encourage strategic investment projects, these debt-related instruments, we see that, and also a share capital adjustments and increase for these companies. So again, we see that the drive to reduce the cost of doing business and the cost of investment in Uganda. So any investors in this category will be entitled where they sign debentures, where they sign instruments imposing further charges that's relating to mortgages, where they advance additional funds, and then where they lease land, they'll also be exempted from stamp duty. Where they increase their share capital, they will be exempted from stamp duty. Transfers of land, again, we see the drive to ease the access to land for such projects. And then agreements where they seek to conduct feasibility studies and develop designs for construction are also enabled by removing the burden of stamp duty. So just for our knowledge, I'll just list that the strategic investment projects, the category of strategic investment projects. Now, these include developers of industrial parks and free zones, or free zones with an investment capital as listed $50 million, and then operators within the industrial parks and free zones are also considered strategic investment investors, and then also operators of single factories or other businesses outside the industrial parks. So there are thresholds that are set for these, but the aim is to promote industry and also to increase agro processing, because in the category of strategic investment projects, we have agro processing, food processing, medical appliances, building materials, light industry, automobile manufacturing and assembly. We have logistics and warehousing, information technology. So again, governments aim to enable strategic investment, increase opportunity for job creation, and involvement for Ugandans is seen clearly. So the other strategic investors are hotel or tourism facilities, as well as hospital facility developers. So these will be exempt from stamp duty if they meet the conditions. The last amendment act I'll look at is the Mining Amendment Act, which also seeks to increase revenue and also improve Uganda's economic performance. So the Amendment Act 2021 introduces a levy on the exports of processed gold from Uganda. So effective 1st July 2021, 5% of the value of a kilogram of processed gold that is exported out of Uganda will be payable by those exporters. And that tax will be payable to the URA. Then also we see that continued drive to promote processing of minerals and to also add value in the minerals sector. So there will be a tax, a levy of 10% of the value of unprocessed minerals exported out of Uganda. So again, we see government moving towards industrialization, processing, value addition, just to make sure that we are competitive on a global market. So we believe that these changes to these acts will definitely move Uganda in the right direction to economic recovery, and we wait to see the implementation of these amendments. Thank you for listening to me. I will now hand over to Anne to take us through the question and answer segment. Thank you.
Thank you so much, our team from PwC. I believe with all the discussions and presentations we've had this morning, that the participants, our audience, have taken away the key things that they need to know from the tax amendments that were made and the implications. Now we are open for Q&A, and I would like to request the team from PwC to respond to those questions, starting from the first ones. I think, Harriet, you will take over this, or is it Diana?
Yes, we will take over this. This is Daphne.
Thank you.
Okay. Thank you. I'll start with the first three questions that were raised in respect to rental income, the amendment on rental income. The first question was on, is the interest of financial loans an allowable deduction, even with a 75% deduction? And I'll answer that together with the second, which was on, will the industrial building allowance in addition be allowable in addition to the 75% deduction? Previously, like I had mentioned, is rental tax for individuals, and as per the previous law, the taxpayer was allowed a standard deduction equal to 20% of rental income as expenditure and losses incurred in that year. Second, they also had a deduction in interest on a mortgage from a financial institution as expense incurred by that individual to acquire or construct the premise. And thirdly was the annual threshold of 2.8. For the non-individuals, the rental income tax computation had allowed them the deduction of their actual expenses, also allowed them a deduction of the capital allowances. And however, when we look at this new law, what this new law is implying is that both the individuals and non-individuals will only have a deduction of 75% of their total gross rental income, meaning the percentage will apply on the gross rental income that they have derived in that year. If it's 100 million, then the deduction for that year will be 75% of the 100. And we are still also waiting to hear from the URA to verify this, because how will the computation of rental income be structured in the tax return? And this will give us more guidance on, for example, for the non-individuals, do I still include in my capital allowances, that includes the IBA, or is it limited to just my rental income and then automatically the computation computes the 75%? Then similar to the individuals, will the interest on the mortgage still be a deduction as per the legislation, or will it be blank that now the rental income would be only allowed 75% of the gross rental income that I have incurred? So that's the clarity that we're still also waiting for from the URA, and they provide guidance to the taxpayer, and so that the taxpayer can be aware of what they should expect at year end. Then the last question on the rental income was, is if the 75% is subject to submission of proof of expenses? And there the answer is no, because the amendment does not indicate that submission of expenses is required. To move on, before I hand over to Harry to take us through the VAT questions that were raised, there was also a question on clarifying on the exemption of venture capital funds for income tax. And like I had mentioned, so the capital gains and losses arising from the sale of investment interest of a registered venture capital fund, that is, the venture capital fund has to be registered under the Capital Markets Authority, then they will not be recognized if at least 50% of those proceeds on sale is reinvested within the same year. If less than 50% of the proceeds on the sales are reinvested, then the venture capital fund will only be entitled to a non-recognition of a gain or loss which is equivalent to the percentage of the reinvested proceeds. Thank you. Let Harriet take us through the Q&A in respect to VAT.
Thank you very much, Daphne. Yes, so the first question for VAT is, okay, it reads like, is this for B2B or B2C transactions alone? Now, understanding is that you're implying business to business or business to customer transactions alone. Yeah, so based on that understanding, we are of the view that if the receiving entity is a business that is registered for VAT, then the non-resident person will not be required to file a return because the registered recipient is actually accounting for VAT on the imported services. However, where it's a receiving business that is not required to register for VAT or is not registered for VAT, then that non-resident person will be providing services to a non-taxable person, and therefore they will be required to account for the VAT. Yeah, then when it gets to the B2C transactions, again, where the consumer is registered or not, it will follow the same argument because a registered customer or consumer will be accounting for the VAT on the imported services where applicable. Just in case we didn't get your question, our understanding right of your question, kindly let us know. We'll get back to you with more clarification. Then the next question was, when do we expect clarification from the URA? Okay, we cannot state with certainty as in when to expect clarification, but most probably it will be before the end of the first 3 consecutive months that are being referred to, that is July, August, and September. So really, URA should have come up with guidance by the end of the 15 days after September, because people need guidance to file or to account for the VAT. Then the next question is whether there is need for a non-resident person to appoint a tax representative. Again, this will depend on the guidelines that URA is going to come up with and share. However, what we know or what we've been informed is that the VAT return going to be used by the non-resident is going to be a very simple return, and the non-resident can be able to do it on their own. But again, this is subject to guidance and the actual return when we see it after it's been shared by the URA. And then we also have a question whether 5% portion of VAT will be paid. Which mechanism is URA going to use to pay the 5% portion of input tax incurred, I imagine by the non-taxable person who has IFRS invoices or e-receipts? So at the moment, what we are told is that URA will remit the refund to the person's mobile money account. Yeah, but again, that will be subject or confirmed when the actual guidelines or guidance is published by the URA. So we're expecting it to be remitted via mobile money, but in the meantime, it's subject to final guidance or confirmation by the URA. Yeah, thank you very much. So going back to Anne for more questions.
I would like to propose that if there are no other questions, we close the meeting because we already 2 minutes past our time. So are there any further questions from the audience?
Yes, I have a question.
No, please write it down.
It's written, it's in the messages.
Which one?
Yes, Anne, I've sent them 2 more questions.
Okay.
So the first is on the who pays the 6% withholding when you sell a property, the buyer or the seller. Now the 6% withholding is on the purchase of a business asset. and this is payable by the buyer of the asset. However, this is not a final withholding tax. That means that the buyer will be able to generate a withholding tax certificate from the URA portal, provide this to the seller in order for the seller to be able to use that tax credit to offset any future income tax liabilities that they would have. And like I had mentioned, this 6% and for in respect to the sale of business asset does not qualify for an exemption for withholding, similar to other payments. Then the last is on, sorry, there is also one that states, if we could go through if we go back to the slide of venture capital, let me get back to that. Yes, so this is our slide on venture capital. And yes, like I had mentioned, so if venture capital funds are pooled investment funds, they manage the money of investors who are seeking private equity stakes in startups and small to medium-sized enterprises. And these venture capital funds, like I mentioned, they have to be registered with the capital markets, registered under the Capital Markets Authority Act. And the purpose of setting up these venture capital funds is mainly to support the startups and also the small to medium-sized enterprises. So, and do they need to be registered? Yes, like I mentioned, they have to be registered under the Capital Markets Authority Act. Yes, so let me see if there's any other question. Yes, so there's also a question about what about personal property withholding? I believe that's in respect to the 6% withholding. Now, when you look at this provision is in respect to a purchase of a business asset. Now, a business asset has to be one that the taxpayer is using to generate income. And it wouldn't be, for example, like your residential home, because except if you use your residential home to also derive business income. Yes, I hope that clarifies. Thank you, Anne.
Yes, thank you.
Because of time, we'll get back to any other questions that were not answered offline.
Yes, sure. We shall do that, and we'll share with you. I think one just came in, but let's send that when we are sending out the recap. Thank you so much, the team from PwC. Thank you, Hilda, Nicholas, Harriet, Patricia, and Daphne. You have shared with us great knowledge, and I believe that everyone that is logged in here has learned quite a lot. If you do have any further questions, clarifications that you need, let us know and we shall liaise with the team from PwC. I see James's hand is up. Please, James, type down whatever you'd like to tell us, and then we shall get back to you. Otherwise, right now, we are closing this meeting. I would like to thank PwC management again for accepting to present these tax amendments to our members and also the non-members that are logged in here. We shall be doing many more with the PwC and also other members of ours. So please stay tuned. We shall let you know when we have our next event next month. Have a great day. See you next time.